Hey everyone, welcome back. Today we're diving deep into The Simple Path to Wealth by J.L. Collins.
Oh, yeah, this is a great one.
It is, right? I think everyone listening is probably interested in learning about personal finance and building wealth, and this book's got a ton of practical advice and real-life stories.
It does.
So think of us as your guides, helping you guys navigate the path to financial independence.
Yeah, and what's interesting about Colin's approach, I think, is that he doesn't really use a lot of financial jargon. He breaks down all these complex concepts into clear, actionable steps. Anyone can understand them, you know?
Yeah, and the story behind the book is really cool too.
Yeah.
He originally wrote it as a series of letters to his daughter about managing money wisely, and it's kind of like a personal finance roadmap that gets passed down through generations.
It is, and that's what makes it so relatable, you know? Collins shares his own ups and downs,
Oh, yeah.
including some tough times, and it just proves that you don't have to be perfect to be successful.
Yeah, and he talks about that a lot.
Yeah.
Okay, so let's unpack this simple path, right?
Yeah.
Collins breaks it down into two phases: wealth accumulation and wealth preservation. It's like building a house.
Okay.
First you lay a solid foundation,
Yeah.
and that's wealth accumulation.
Exactly. Wealth accumulation is all about building a financial base
Mhm.
that covers your basic needs, and it gives you security and stability so you can focus on other aspects of your life.
Yeah.
And he even uses the term FU money to describe this
I think
phase,
it does.
which is a little cheeky, but
It's a little out there.
it really captures what it means to have that financial safety net.
It does. It gets your attention, that's for sure.
Right.
But beyond the catchy phrase, I'm curious, what does FU money really look like?
Well, Collins, he uses a personal anecdote. He wanted to travel Europe,
Okay.
but his boss wouldn't give him the time off, so he quit.
Oh, wow.
Because he had built up that financial cushion.
He had that FU money.
He did. He was able to take the risk and follow his passion, you know?
That's awesome.
That story always resonated with me because it highlights the power of financial security.
Yeah.
It's not just about the money, it's about the freedom to choose how you spend your time and energy.
That's such a powerful example.
Yeah.
I think a lot of people dream of having that kind of freedom.
Yeah.
But it's easy to get caught up in the day-to-day and lose sight of the bigger picture. Before we all book our flights to Europe, Collins reminds us that we need to be mindful of common financial pitfalls.
Yeah, absolutely. One of the biggest ones he talks about is the danger of debt, falling into the debt trap.
Uh-huh.
And he even uses his own experience with credit card debt as a cautionary tale.
Oh, yeah.
It's so easy to get caught in that cycle of spending more than you earn
It is.
and then struggling to pay off those high interest charges. It's like a treadmill. You
Yeah.
can't get off.
And credit cards can really create that illusion
They do.
of free money. It's like you're not really spending anything until that bill comes.
Yeah.
And then, bam, reality hits you.
And then bam.
And it's a trap that can be really tough to escape.
What's important here is not just understanding how debt works, like interest rates and how it accumulates, but also the psychology behind it.
Yeah.
When you're burdened with debt, it can impact your decision making
Oh, yeah.
and even your mental and emotional well-being.
Yeah. Debt can weigh on your mind for sure.
It can.
So how do we break free from this debt trap?
Well, Collins talks about discipline and prioritization.
Yeah, I remember that.
Yeah, he suggests creating a budget, tracking your spending, and focusing on paying down high-interest debts first. But he argues it all starts with your mindset about money.
Okay, this is where things get really interesting.
Yeah.
Tell me more about this money mindset shift.
He argues that you need to view money as a tool
Okay.
to generate more money. Not just for spending. It's about recognizing the power of money to create the life that you want. And he uses an example, Mike Tyson's bankruptcy.
Wait, Mike Tyson, the boxer.
Yeah. He earned hundreds of millions of dollars but ended up bankrupt.
Wow.
And it emphasizes that no matter how much you earn, if you don't have the right mindset, you can lose it all.
So it's not just about income.
Yeah.
It's about managing what you have.
Exactly. It's about managing what you have and making it work for you.
I think it's easy to assume that if you reach a certain income level, you're set.
Right.
But Tyson's story it's a cautionary tale for sure.
Yeah.
So how do we avoid that? How do we develop a healthier money mindset?
He outlines 3 key principles. First is seeing money as a tool
Okay.
to generate more money, not just spending. Second is understanding opportunity cost.
Opportunity cost. What is that?
It's what you're giving up when you spend money on one thing versus another. So, for example, if you buy let's say, a $20,000 car, you're not just losing the $20,000, you're also losing the potential returns you could have earned if you had invested that money.
Oh, okay. So every spending decision has an opportunity cost.
I've never read it.
It's about looking beyond the price tag and considering the long-term impact.
Exactly.
Okay. So we're thinking about what we're getting, but also what we're missing out on. What's the third principle?
The third is shifting your perspective on investments.
Okay.
Don't view them as risky gambles, but as long-term opportunities for growth and building wealth.
Wow.
He emphasizes that the stock market, it can be volatile, but over the long term, it has historically trended upwards.
So we're embracing the long game. We're not getting spooked by short-term fluctuations.
Exactly, exactly. He uses the example of Warren Buffett,
Oh, yeah.
who said, "Be fearful when others are greedy, and greedy when others are fearful."
I love that quote.
Yeah. Buffett stayed calm and continued to invest even during market downturns. And that's why he's been so successful.
Okay. The stock market, it can be pretty intimidating, though,
It can.
especially for beginners. What
Yeah.
what are some of Collins' key insights on navigating that?
He starts by emphasizing that market crashes are inevitable,
Okay.
but they're temporary. The market always recovers.
Okay.
Trying to time the market is nearly impossible, so he advocates for taking that long-term perspective and just riding out the fluctuations.
So basically, don't panic sell.
Don't panic sell. Easier said than done, I know.
Definitely easier said than done.
But remember, the market generally trends upwards over time.
Yeah.
But this raises a question for you. How do you feel about the risks and rewards of the stock market? Are you someone who can weather those ups and downs?
That's a good question. We all have different risk tolerances.
We do.
But even if we accept that market dips are part of the game, are there things we can do to avoid losses? Like, what are some common pitfalls that Collins warns about?
He points out three big mistakes. First, trying to time the market.
Oh.
Second, trying to pick individual stocks.
Yeah.
And third, getting distracted by what he calls the foam,
The foam.
the media hype and the sensationalism. He suggests focusing on the beer, the fundamentals of the market.
The beer, I like that. It's like ditch the crystal ball and focus on the fundamentals.
Right. Focus on the fundamentals.
Got it. So ditch the stock picking gurus too.
Yeah. He believes in keeping things simple.
Yeah.
He outlines three considerations for building your portfolio.
Okay.
First, what stage of investing life are you in?
Okay.
Are you in the wealth accumulation phase, or are you in the wealth preservation phase?
So different stages call for different strategies.
Yeah.
Makes sense. What's the second consideration?
Your risk tolerance.
Oh, okay.
How comfortable are you with market ups and downs? That'll influence your investment choices.
Makes sense. And the third?
Third is your investment horizon. How long are you planning to invest? The longer your time horizon, the more risk you can take.
Cool. Okay. Makes sense.
Yeah.
So we've considered our stage, our risk tolerance, our time horizon. What about the tools we use to actually build wealth? What does Collins recommend?
He focuses on three essentials: stocks, bonds, and cash. Each has its own role in a balanced portfolio.
Okay. Break it down for us. Stocks first. Why are they so important?
Stocks represent ownership in companies.
Okay.
They offer the potential for high returns,
Uh-huh.
but they come with higher risk, and they're a good hedge against inflation.
Okay, so they offer growth, but also some risk.
Yeah.
What about bonds? How do they fit in?
Bonds are loans you make to governments or corporations.
Okay.
They typically offer lower returns than stocks,
Well,
but they're considered less risky. They can act as a hedge against deflation.
oh, interesting. So bonds offer stability and they can help balance out the risk of stocks. And then finally, cash. Why do we need that?
Well, cash, it earns very low returns. It can even lose value during inflation, but it's the most liquid asset.
Okay.
So you can access it quickly for emergencies, for short-term needs.
Yeah. So cash gives us flexibility.
It does.
Okay. Stocks for growth, bonds for stability, and cash for liquidity.
Exactly.
Each with its strengths and weaknesses. But before we get into how we put them all together, what's resonating with you the most so far?
I think I think the emphasis on simplicity and the importance of our relationship with money.
Yeah, I agree.
It's not just about following rules. It's about understanding the principles and making choices that align with our values and our goals.
I agree. And I think Collins' own journey and his willingness to share his mistakes makes his advice even more impactful.
Oh, absolutely. He's not presenting himself as, some financial guru.
Yeah,
He's a real person who's made mistakes and learned from them.
totally.
And that makes his approach, it makes it achievable.
It does. It feels very accessible. We'll continue this conversation in part 2 of our deep dive. We'll unpack Collins's portfolio allocation strategies, and we'll explore his belief in index funds.
Looking forward to it.
Stay tuned, everyone.
Yeah.
Welcome back, everyone. In the last part, we laid the groundwork for understanding J.L. Collins' approach to building wealth. We talked about the importance of FU money and needing to shift our mindset about money. But now I want to get into the nitty-gritty. Like, how do we actually put these principles into action?
Well, you're in luck because that's exactly where we're headed now.
Okay, good.
Collins, he provides specific guidance for both phases of financial freedom, wealth accumulation, and wealth preservation.
Perfect. Let's start with wealth accumulation then. What's his advice for those of us who are, still in the building phase, working towards the initial financial cushion?
Well, Collins believes in keeping it super simple during this phase.
Okay.
He recommends putting 100% of your investments into index funds.
Whoa, 100%. Are you serious? That seems like putting all your eggs in one basket.
I know it sounds bold, but there's a very compelling logic behind it. He argues that index funds offer broad market exposure, low fees, and a high probability of long-term growth.
Okay.
They're a great way to build wealth steadily without having to become a stock-picking expert.
So instead of trying to outsmart the market, we're just riding the wave.
Exactly. And remember, Collins isn't just throwing out theories here. He's speaking from his own experience.
Right. He used this approach to build his wealth.
Okay.
So he's putting his money where his mouth is. But why index funds specifically?
Well, he acknowledges that other assets, can play a role. But he maintains that for most people, especially those in the accumulation phase, a simple, low-cost index fund is more than enough.
Okay, so he's all about keeping things simple and streamlined, less decision fatigue, more focus on the long game.
Precisely.
Got it. But I'm still curious about the reasoning for index funds. What makes them so special?
Well, index funds are designed to track a specific market index,
Okay.
like the S&P 500. So instead of picking individual stocks, you're investing in a basket of stocks that represent a particular segment of the market. This eliminates the need for you to do all that research.
So it's like outsourcing the stock picking to the experts then.
Exactly. And because index funds are passively managed, they have much lower fees than actively managed funds.
Okay, so lower fees, broad market exposure, and a simpler approach. It's starting to sound pretty good. Are there any downsides, though, to index funds? Are we sacrificing potential gains by not actively picking stocks?
That's a good question. It is true that you might miss out on the occasional home run if you're not actively picking stocks.
Okay.
But you're also mitigating the risk of striking out completely.
Right.
With index funds, you're spreading your risk across a diverse portfolio.
Okay, so it's a trade-off then between higher gains and lower risk. And for Collins, it seems like that reduced risk and simplicity outweigh the potential for big wins.
Exactly. Remember, his philosophy is about achieving financial freedom with as little stress and complexity as possible.
Okay, I like that. So I'm sold on index funds, but you mentioned that Collins recommends a specific index fund.
He does. He specifically recommends VTSAX.
VTSAX, okay. What is that? Why that one specifically?
So VTSAX is the Vanguard Total Stock Market Index Fund.
Okay.
And it gives you exposure to basically every publicly traded company in the U.S.
Wow.
It's like owning a tiny slice of the entire U.S. economy.
Okay, so instead of picking individual winners, we're betting on the collective success of the American market.
Exactly. And historically, the U.S. stock market has trended upwards over the long term.
Okay.
Even with all the dips and crashes we've seen along the way.
It's like that saying, a rising tide lifts all boats. If the overall market is going up, our investment in VTSAX should go up too.
Right. And Collins argues that VTSAX is a great investment for both beginners and experienced investors. It takes the emotion out of investing, which, as we know, can often lead to bad decisions.
So we're taking the guesswork and the emotional roller coaster out of it. I like it.
Right.
But wait, are index funds just for lazy people?
Not at all. Collins argues they're a smart choice for anyone who wants to build wealth steadily without spending hours, doing research or trying to time the market. It's about working smarter, not harder.
Working smarter, not harder. I like that. Okay, so by investing in a broad market index fund like VTSAX, we're basically betting on the collective wisdom of the market itself.
Exactly. And Collins has the data to back up his claims.
Yeah.
He shows us how his initial $10,000 investment in VTSAX grew to over $1.5 million in just a few decades.
Yeah, that's incredible. That's the power of compound growth, right?
Exactly. It's like a snowball rolling down a hill. It gains momentum and size as it goes.
I love that visual. It's a good reminder that consistency and patience are key.
Absolutely. Even small, consistent investments can grow significantly over time.
That's amazing. But what happens once we've built up that snowball, so to speak, once we've reached that wealth preservation phase?
Right, good question. For this phase, he recommends a slightly more diversified approach,
Okay.
shifting from 100% stocks to a mix of stocks, bonds, and cash.
So we're adding a little more stability then. Why the change?
Well, as you transition into wealth preservation, the goal shifts from maximizing growth to balancing growth with capital preservation.
Okay, so we've worked hard to build our wealth. Now it's time to protect it.
Exactly, exactly. And that's where bonds come in.
Okay, but what's the logic behind adding bonds?
Well, bonds, as we talked about earlier, are generally considered less risky than stocks.
Right.
They provide a steady stream of income and can actually help cushion your portfolio during market downturns.
So they're like a safety net to help protect our hard-earned money.
Exactly. They add stability to your portfolio.
Okay, that makes sense. So how much should we be putting into bonds in the preservation phase? And what about cash? Does that still play a role?
So Collins recommends a 7-5-2-0-5 split.
Okay.
75% stocks, 20% bonds, and 5% cash.
So a little less aggressive than the 100% stock allocation. But why those specific percentages?
It's all about balancing risk and return for someone who is no longer actively building wealth, but is living off of their investments, or at least preparing to.
Okay.
75% in stocks still allows for growth. The 20% in bonds provides stability and income, and the 5% in cash offers liquidity.
Okay, so it's a balanced approach that aims to protect our wealth while allowing it to grow at a reasonable pace.
Yeah.
I like that. But how did Collins come up with those percentages? Is there some kind of formula behind it?
Well, while there's no magical formula, his recommendations are based on years of research,
Okay.
historical market data, and his own personal experience as an investor.
Okay, so he's basically distilled his knowledge into a set of guidelines that have proven effective over time.
Right, exactly.
But can we really trust this simple path to lead us to wealth? Like, it sounds almost too simple.
Well, Collins isn't just offering theoretical advice. He's sharing the principles that he used to achieve financial independence and retire early.
Right.
He backs up his recommendations with data, historical market trends, and his own personal experience.
And he's really transparent about his journey, about all the successes and the mistakes he made along the way.
He is. He's not afraid to, admit when he messed up.
Which I think makes him more relatable and trustworthy.
Exactly. It shows that, this path to wealth is achievable, even if you don't have a perfect track record.
Okay, so we've talked about wealth accumulation with the 100% VTSAX strategy and wealth preservation with the 75205 allocation.
Yeah.
But I want to circle back to VTSAX for a second. Collins seems incredibly, I guess bullish is the word on this index fund.
He does.
It's like he's put all his eggs in that one basket.
You're right. He's very bullish on VTSAX. He even calls it the lazy portfolio.
Lazy portfolio.
Because it requires minimal effort and management once you've set it up.
Okay, lazy portfolio.
Yeah.
I kind of like the sound of that. But why VTSAX specifically? What's so special about that one?
Well, as we said, VTSAX gives you exposure to every public company in the U.S.
Yeah.
And remember, it has very low fees.
Right.
Which make a big difference over time.
Okay, so instead of trying to pick winners, we're betting on the overall success of the American market.
Right.
Like we're showing confidence in American businesses.
Exactly. And historically, the U.S. stock market has trended upwards over the long term.
Okay, makes sense. But are index funds really just for lazy people, as some critics might say?
Not necessarily. Collins argues that index funds are a good choice for both new and experienced investors.
Okay.
Because they remove that emotional element from investing, which can be problematic.
So we're taking the guesswork and the emotions out of it.
Right. You're essentially betting on the collective wisdom of the market.
That's a good way to put it. And we talked about his own $10,000 investment that turned into $1.5 million.
Right. That's the beauty of compound growth.
It's pretty amazing. But
Mm.
but are index funds really enough?
Well,
Should we be diversifying into, I don't know, real estate or gold or even cryptocurrencies?
yeah, that's a great question. Um, Collins acknowledges that other asset classes have their place, but he maintains that for most people, a simple, low-cost index fund approach is really all they need.
Okay.
He emphasizes that complexity often leads to confusion and higher fees,
Right.
which, can really hurt your returns.
Okay, so he's not saying that other investments are bad. He's just saying they might not be necessary for most people.
Exactly. Especially those just starting out. He's
Yeah.
all about keeping things simple and effective.
I love that. It takes the pressure off,
Yeah.
knowing that we don't need to become financial wizards. We don't need to be constantly researching new strategies or trying to, time the market.
Exactly. His message is about empowering people
Yeah.
to achieve financial freedom.
It's really a relief to know that it doesn't have to be so overwhelming.
Right. It just takes the right mindset, a bit of discipline, and a willingness to learn.
We've certainly learned a lot from him today.
We have.
We've explored the two phases of financial freedom, the power of index funds, his recommended portfolio allocations.
Yeah.
But before we wrap up, I want to go back to this key point that Collins talks about.
Yeah.
The importance of FU money and how that can change your life.
Yeah. It's a powerful concept.
It is.
It's not about being rude. It's about having the financial security to make choices that are aligned with your values.
Like quitting your job to travel the world.
Exactly. Or starting your own business, or just having the freedom to say no to things that you don't want to do.
Yeah, that's true freedom. And it starts with making those smart financial decisions.
It does. It starts with building that solid foundation.
And embracing the simple path to wealth.
Right. But remember, financial freedom is not just about money. It's about aligning your financial choices with your life goals and values.
Right. It's not about the money itself. It's about what the money enables you to do.
Exactly. It's about creating a life of purpose.
Yeah.
And meaning with a healthy dose of FU money to help you along the way. We'll continue this conversation in part 3,
Okay.
where we'll wrap things up and leave you with some questions to think about.
Welcome back to our deep dive into the simple path to wealth. It's been really interesting exploring jlcollins' philosophy and strategies and all those stories he tells. But now let's talk about what it all means for you. How can you actually use these insights in your own financial life?
That's the key question, right?
Yeah.
We can learn all this stuff, but the real power is putting it into action.
Right.
So let's try to break down some of the big takeaways.
Okay, I like that. Let's distill some of the key points. For me, one of the biggest things is his focus on simplicity. He cuts through all that financial jargon, all those complicated investment strategies to give us this clear path to building wealth.
Absolutely. He really boils it down, right? Spend less than you earn, avoid debt, invest consistently, and keep it simple.
Yeah, and he doesn't just tell us what to do. He explains why.
Yeah.
Like I remember his explanation of compound growth.
All right.
And how even small, consistent investments can grow into significant wealth. It's like planting a seed,
It is.
If you give it enough time, it can grow into a mighty oak tree.
That's a great analogy. And understanding that power of compound growth can be really motivating. It shifts our focus from those quick wins to that long-term growth.
Yeah, I agree. And another thing that I took away from this book is the importance of changing our mindset about money.
Yeah,
Dr. Collins, he challenges us to see money not just as something to spend, but as a tool to build a life of freedom and purpose.
Yeah, it's a total shift in perspective. It's not about just hoarding wealth. It's about using it to create the life you want.
Exactly, to follow your passions and have that security to make choices that really align with your values. And I really appreciate that he talks about the emotional side of money too.
Yeah.
He doesn't shy away from that fear and uncertainty that we all feel. especially when the market's it's going crazy.
It makes his advice, I don't know, it makes it feel more real, more human.
It does. It does. And he's been there. He's made those mistakes and he's learned from them.
And by sharing those lessons, he helps us kind of navigate all those emotions that come with investing.
Right, exactly. He normalizes it all. It's okay to feel uncertain or scared, but the key is to have a plan and stick to it. Don't let your emotions make those decisions for you.
Yeah, having that solid plan, having that long-term view, that can help you get through those tough times.
Okay, so speaking of plans, we got to talk about his argument for index funds,
Right.
specifically VTSAX as the foundation of a wealth building strategy.
He's a big fan of index funds, and for good reason. They're simple, they're low cost, and they're an effective way to kind of ride that wave of economic growth.
And VTSAX, it's got a pretty impressive track record.
It does.
Past performance isn't everything, but it's something.
Right, right. It's a good option for people who want to build wealth without getting lost in the complexity of stock picking.
Okay, so if we follow his advice, we don't have to become day traders,
Yeah.
stressing over every little market fluctuation.
No, his approach is all about, it's about simplicity, consistency, and really the power of long-term investing. It's about setting yourself up for success, without all that stress.
I like that. It's really nice to know that it doesn't have to be so complicated.
Yeah.
But what about people who are already retired or getting close to retirement? Does this simple path still work for them?
It does. Collins talks about that wealth preservation phase, where it's about balancing that growth with protecting what you've already earned.
Right.
He recommends a bit more of a conservative approach,
Right.
with a higher percentage in bonds to help you ride out those market drops.
So it's not like a one-size-fits-all approach.
Exactly. It's about adapting those principles to your own situation, your own goals.
Right. So the core message is still the same.
Yeah.
Simplify, invest consistently, and let compound growth do its thing.
Exactly.
As we wrap up this deep dive, I feel really optimistic. It feels
Right.
like anyone can achieve financial freedom if they follow these principles.
Yeah, that's the great thing about his message. It's really empowering.
Yeah.
He makes personal finance accessible.
Yeah.
He's not promising to make you rich quick. He's offering this roadmap to a more fulfilling life.
I agree. And he leaves us with this final question.
He does, yeah.
It's a thought-provoking one.
Mhm.
He asks, if you had the financial security to make any choice, what would you do? How would you design your life?
It's a great question. It makes you think about what really matters.
It does. It really does. It makes you think about how you would use your resources to create that life that really aligns with your dreams and your values.
And, ultimately, that's what it's all about. Financial freedom isn't just about the numbers. It's about the freedom to live a life, a life on your own terms.
So to all our listeners out there, go out and build your own simple path to wealth. Remember, the journey is just as important as the destination.
It is.
Thanks for joining us on this deep dive. We'll see you next time.
See ya.